Welcome to Fitz Factor, the show where you learn how to master the stock market with Dan Fitzpatrick, the stock market mentor. Dan is a savvy trader. He's featured regularly on Fox Business, CNBC, Investors Business Daily, and SiriusXM Radio. In this podcast, Dan shares his insights on trading, life, and attaining long-term success in the market.
Dan, one thing I would love to know about, looking at your active trade list and that specific trade you have on MSTX, which is up 19%. What are some of your technical and mindset strategies for handling a hot stock like this? A stock that goes up a lot in a short amount of time. It can be hard to deal with because all of a sudden people are like, they're making a lot of money in a short amount of time. That can mentally mess with you. But then also from a technical standpoint, how do you manage something like that where it might go up a lot, but it also might pull back a lot? And that might be normal price action for a leveraged ETF or a stock that is hot. It has a lot of people's attention. So what are some of your strategies for managing a hot stock?
Well, that's a really, really good question. And it is important to have some strategies for that. This is just how I do it. I'm sure there's other ways to do it that are maybe even better. The way I look at this is it's a combination of managing my emotions through understanding what's really happening in the market and in that particular stock. If I have an understanding, some kind of an underlying sense of what's going on, I feel more confident in what I'm seeing. And case in point, when the yen carry trade blew up, seemed like the market was going to zero, like everything just really, really tanked. Because I understood what was happening, it was easier for me to manage myself in that situation. And what I mean is, if you understand what happens when all these knuckleheads, most hedge funds lose money, guys, and they definitely don't outperform the market. So if you have an opportunity to invest in a hedge fund, why don't you just manage your own money? You'll do better. So when all these hedge funds are leaning the wrong way, they get whacked on this carry trade. Well, their brokers aren't saying like, golly gee, guys, I guess we really took a bath on that one. No, they have a massive amount of margin calls that they have to meet in order to stay off the breadlines. So what are they doing? They're selling Meta. They're selling this. They're selling that so that they can raise the cash. Okay, so if you know that, if you just know what's going on in the market, it's easier to say, oh, I get it. I think I'm going to buy right here rather than run for the hills. So the reason I'm even bringing that up is because it has to do with understanding market dynamics. I think that one could trade purely on technicals, go in a cave as long as you got one of Musk's Starlink internet things and you got pretty good electricity, I guess, with your laptop. You could trade totally on technical analysis. No news, no nothing, just look at the charts. That's all well and good, but it's a heck of a lot easier if you have an understanding of what's actually happening in the market so that you can make a little more sense out of this stuff. I think that's really important. And so I'm doing a little bit of the weave here, Scott, but I am answering your question. So understanding market dynamics really, really helps in managing big positions. Technically, and I'll get to mindset in a minute, but technically, like let's just go away from MSTX and go to MSTR. So it's really the same chart, but one of the things that you'll see here is like the 8-day exponential moving average is what's defining buy points. It's defining the trend, which is up. Okay, this is what I know. Big institutions don't just buy a whole bunch of stock one day and then the very next day go, oh crap, somebody hit the buy button. We meant to hit the sell button. Let's get rid of everything. They don't do that. They will buy in a series of stages that can go on days, weeks, or months. In fact, this weekend, I'm teaching a 59-minute trader update. I think the workbook's over 300 pages. I know it's over 300 pages because I wrote them all. Part of that strategy is understanding how institutions work. And so we're talking about managing big positions, Scott. One of the things that is really important for people to know is, I think it's like 40% of the trading volume each day occurs in the first half hour and in the last half hour of trading. And so there's a lot of activity first thing in the morning. Okay, so what does that mean? It also means that there's not a lot of activity during the whole rest of the day. So So when you're managing a big position, for me, every day when I come in, I'm saying like, okay, well, what are the institutions doing? Are they still buying? Are they not buying? I'm not looking at it at 11:30 or noon, wondering what they're doing, because they're probably either out taking a smoke break if they still smoke, or just grabbing lunch or something. So I care about the opening rotation, and what I see in the opening rotation helps me get a better sense of what's happening. And so when I have a position like I actually don't have as big a position in MSTX as I did when we started this, because I had some stops and they just got hit to protect my position. So let's talk about that. When I've got a big position, it actually just kind of starts off as a regular position. I need to see the stock moving in my favor. And when it's a really volatile stock, this might seem a little bit counterintuitive, but when it's a really volatile stock, I actually want to take a bigger position in that, which is contrary to what a lot of traders will say is like, no. If it's really volatile, you want to take smaller positions. And I say, no, manage the volatility and capitalize on it. But this is what you need to understand. Having a big position doesn't entitle you to make a lot of money, but it also doesn't relegate you to losing a lot of money either if you're managing it accordingly. So like what I would do, Scott, is
if you're getting value from this podcast, click the subscribe button and sign up for Dan's free daily videos at stockmarketmentor.com.
this orange line here is the volume weighted average price that I'm showing. I'm looking at the upper right-hand corner on a 15-minute bar chart. Okay, so I was pretty long this. It was my biggest position coming into today. And so when this thing opens up above the first level of resistance of R1, that's almost $53 just on pivot point analysis. When it opens up there and then it holds, I'm thinking, okay, I want to build my position because this thing really looks like it's going to the moon. Might not, but it might. So I want to be there. So what do? I'm not thinking about the position that I already have. This is a new trade. The position that I already have is already planned out and protected. I have my stop set. I know exactly what my risk is, whether if my stops are hit, will that lock in a gain or will it just be limiting my losses? But I know exactly what my risk is on that position. Therefore, as far as having the stress of how, oh my gosh, how do you handle the stress? You eliminate the stress. You never let it get to that point. And you do that by defining what your risk is. Like if your house is insured, fully insured, you know what your deductible is, then are you really going to freak out if there's, in California here, a forest fire? I mean, yeah, it'd be a drag and all that, but as long as you're out, you know what your loss is going to be. Without insurance, you have no clue. And so my idea for trading is I set stops, and those are my insurance premiums that I'm basically dealing with. Anyway, as the stock moves up though, and I'm saying like, okay, I want to buy more. I do know that I'm buying more. And so by definition, it's like I'm chasing the stock. But at the same time, I'm treating it as a new trade with a new stop. And so I'll be buying here a little over $53. So right away, I'm saying like, okay, where would I be selling this stock to show that I'm wrong? If I realize I'm wrong, like where's the oops, I'm wrong level? And so it'd probably be like 51.95, something like that. So, all right. So how much am I risking? I'm in at 53.28. My stop's at 51.95. That's my risk on that trade. It's the only trade that I care about. Everything else is already taken care of. Does it all equate into a huge position? Yeah, but it's not a huge position. It's a series of smaller positions, each of which is protected. And so that's how I manage my positions. Again, it's not just one huge position. It's a bunch of little positions on the same stock. And so I look at different time frames like the 15-minute chart. Okay, what's the last low? What's the last high? And then I'll base my stops on things like that. But from an emotional standpoint, this is really important. You have to understand that this trade could work, it could not work. You don't get a vote. You cannot control it. And so I'm hoping that this thing goes up to $70. That's not my target. That's my prayer. So I'm hoping that it goes up to $70. But if this thing fell down to 30, that would be a drag because it didn't go to 70 and I didn't make very much money on it. I actually made good money on it because I had my positions covered all along the way, but it just didn't work out the way I had hoped. But it worked out the way it worked out. Here's my point. You have to go into every trade, and particularly big trades, knowing that the trade could go against you. And it doesn't mean that your process was wrong. You could have a really, really crappy process and make a boatload of money, or you can have a pristine process and lose money because the stock's going to do what the stock does. And so I just say this, and then we can talk more about it if you want. But I would say don't be wedded to the outcome. Just say, you know what? The stock's going to do what it's going to do. I've seen this before. I have a process to manage this. And so instead of just piling in and saying, like, I'm all in on mystics, say, I'm going to make a series of trades here. This could work out really, really well for me, but I'm going to make sure that if that goes against me, it's still not going to work out badly. It's not going to hurt me. So does that make sense what I'm saying, Scott?
Absolutely. So from what I'm getting from what you're saying, Dan, is that you're using stops, you're using multiple time frame analysis and a history of seeing this type of trade and this type of pattern play out over and over again. You're also managing your size, but following that momentum higher until it stops working for you.
Yeah. And you have to put yourself in a position. First of all, anybody can do this. I've been trading since 96. Okay, big deal. A lot of those years I was trading badly. The point is, all the things that we're talking about here, anybody can do. You just, again, have a process. And yeah, stops are really, really super important to have. And that's kind of a little bit of an art, but these are just things that you have to always be looking at to protect your downside. And there's some skill in that because you say, okay, I'm protecting my downside. So you have a really tight stop. Well, you might as well just sell the stock because you're going to get stopped out. So you have to kind of understand there's a method to placing your stops and always be aware of where your stops are and what your ultimate position is. That helps manage the mind because the mind matters in matters of money. This is something that I struggled with a lot when I was younger. If I was having kind of a bad, like I wasn't trading very well or something, or maybe just the market wasn't treating me very well, and then I had a good trade going, I would want to ring that cash register just so I could feel good. You know, yes, I'm up 15%. That's awesome because I've lost my asterisk on the last 5 trades or something like that. I would be making one trade to make up for the emotional damage that I took on these other trades. Okay, well, maybe that makes sense psychologically. It's like a compensating factor, but it doesn't make sense if you're just looking at lines and trades. It doesn't make sense. Like, do you think MSTX really cares at 53.65 that I might be feeling stressed or anything? No, it doesn't care. Stock's going to do what it's going to do. Most important thing is to be able to hang in there with a good position as long as the stock's working and allow your good position to be a great position. A good example of that is NVIDIA from back here in January. I mean, this stock absolutely screamed from 50 up to almost $100 in just a few months. So if you were sitting there licking your wounds because you'd had some bad trades in some other stocks, you'd have sold NVIDIA when it was up 20% and you'd have felt really good about it until you realized that you sold way too soon. So why did you do that? Because of the emotions. You want to treat every single trade as if it's the only trade you're in. You learn your lessons from things that have happened before, but you don't carry any burden or bad memory with you going forward. You know, the whole unburdened by what has been thing and all that. A good trader takes the lessons, but they don't carry the burden from past bad trades with them. And the reason is if you're always feeling like, oh, I got to make up for this or that, you'll never make a big trade. You won't allow yourself to make a big trade because you're always going to want to be locking in a good trade. And so treat each position, like treat each chart like it's the only thing in the universe, and then just use the things that you know to let the stock reward you. And sometimes the stock's really going to reward you. Other times it's really not, but it's not the stock's fault and it's not your fault. That's just the way things are. That's just the way things work out in trading. It's called trading. It's not winning. If anybody can show me winning, let me know, and I'm all in.
Dan, one thing I've noticed as well is that when some people and their personality tends to make them overtrade when they are in a big winner. So what I heard you say as well is to watch some of these key moving averages to try and hang on to a stock while it's above a key moving average or a volume weighted average price, so that you can allow yourself to stay in the stock while it's trending. Because if you bring up that chart of NVIDIA again, there are a handful of red days on that daily chart within that big run early in the year. And there's multiple reasons, even just in the past few months. Anyone can look at the chart and say, well, I got taken out there. And they got taken out there for a good reason, but then the stock continued higher, maybe without them. And so I think that over trading as well is a big thing that some traders can find themselves getting into when they do have a hot stock or a big winner.
Your point is really a good one. Like, I just switched this to a line chart, and it kind of cleans things up a little bit, because all you're seeing is closing prices. And you see, every so often there's a big pullback here, but the trend can be really clear. But if you're looking at candlesticks, it's a little bit easier to get shaken out if you're not fully committed to it. But you're always going to get that noise in every stock, but got to be thinking of things from an institutional standpoint. We don't want to be trading against institutions. We don't even want to be trading with institutions. We just want to know what institutions are doing and then just hop on and enjoy the ride. Because if you're doing that, you're going to wind up making money more often than losing money. But what you're talking about, Scott, with respect to like volume weighted average price. So we're looking at volume weighted average price and pivot points. So this is an important rule of thumb. Never violate this. The only time, and I'm talking about shorter term trading, you could talk about any kind of trading, but the only time you want to be long is when a stock is above the volume weighted average price, because just that simple relationship there tells you that institutions are buying the stock. Because the way institutions trade is they have like desk traders or order takers, whatever you want to call it, all these different firms like, Fidelity is buying a gob of this stock. Well, what do? Okay, they spread out the order to several different trading desks. And they don't just give it to one trading desk. They spread it out over different desks so that they can see who gets the best fills. And also, they don't want somebody to know exactly how many shares or how much money they're putting in to a certain stock. So they'll spread it around, and nobody really knows what everybody's doing except the firm that's placing that big order, right? And so the idea of the VWAP, volume weighted average price, which is updated every day by each tick. Like, everything is factored in. So, at any given time, like today on NVIDIA, right now, volume weighted average price is $141.49. So right now, you'll see NVIDIA trading below the volume weighted average price. Well, what does that mean? Okay, that means the volume weighted average price is the line of demarcation between buyers and sellers. So the stock's below the volume weighted average price, which means there's selling pressure, and the volume weighted average price is going down. So you don't want to be into a stock like that when every time it goes up to the volume weighted average price, it reverses and goes lower. Like, that's just stupid, unless you don't know about this, in which case, well, now you do. So the only time you want to be buying is when it is above the volume weighted average price. This is such a good tell. You know what's happening if a stock goes up in the morning above the VWAP and it's all good in the hood, and then kind of gradually starts drifting down 10:30, 10:45, and then it kind of starts running right along the volume weighted average price. And then just watch it, because sometimes you will see the middle part of the day, maybe 1 o'clock, 1:15, 2 o'clock, you'll see the stock just start to tick up off the volume weighted average price. What that's telling you is, yes, there's still buying interest in this stock, and some order filler, whatever, is going like, holy crap, this is my opportunity to buy the stock right at the average price of the day, because I'm not going to get fired if I'm buying the stock at the average price of the day. They want to be buying as much stock as they can right at the average price of the day. So by the end of the day, they've got a really nice report to the mutual fund or whoever has given them that order. So you can tell, like, okay, a stock's at the VWAP. What's going to happen? Are we buying or are we selling? What's going on? Don't guess. Let the stock give you the answer. If the stock starts going up, you want to be long. If the stock starts going down and falling below the volume weighted average price, don't necessarily short the stock, but at least don't be long the stock, because you've learned what institutions are doing. They're buying or they're selling. Oh, it's below the volume weighted average price. Well, they're selling. Okay, well, I don't want to be taking their order. I want to be taking the other side. I'll wait. And so this is one of the things that can give you a really good idea of how to trade, is just looking at the volume weighted average price.
Thanks for listening to Fitz Factor with Dan Fitzpatrick. If you like this, then you'll love Dan's premium service at stockmarketmentor.com, where you can learn how to trade stocks, options, and cryptocurrencies. Click the link below and get access to real-time trading alerts, a community of traders just like you, and live training sessions each week. Get the trading edge that you need at stockmarketmentor.com.